Simultaneously, because they are a bank that has a niche in the startup community, what comprises a good portion of startups today happens to be companies that are involved in the crypto industry. So with what so happened was that these companies, along with other startups, were burning money since about November of 21. So what happened was those companies were pulling their deposits out, and SVB was left with these long-term assets that they had to sell in order to meet those deposit withdrawals. So they had to sell those securities at a loss.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your host, myself, Tim Bickmore, and my colleague, Nathaniel Leach. And today, we're going to talk about some hot news that happened from approximately like Thursday night.
So Thursday the 9th.
Thursday, March 9th, and then just really got heated up all the way up until today, which is Monday, March 13th.
Yep.
We are going to talk about, like everyone has talked about on Twitter, LinkedIn, pretty much anywhere you could go, Silicon Valley Bank collapsing. They collapsed on March the 10th, I believe, technically speaking, where the FDIC stepped in, seized the assets, held everything out. So we want to talk about what is going on, what happened, and of course, we have Nathaniel here to talk about this. But before we jump in, let's give a little bit of history about Silicon Valley Bank and where they come from, what got started, just for our listeners to understand. So SVB is what a lot of people are, the acronym. So Silicon Valley Bank. They were started in 1983. They primarily focused on venture-backed companies as a clientele, like a client base. So they helped support them in a lot of different ways, obviously through just banking. There was some also liabilities, loans, subscription lending is what Nathaniel was telling me earlier that they would provide. And that was their niche. And they really provided a pretty good backing for that ecosystem. They were the top 20 American commercial banks in the United States. At the time of their closing, they were actually the 16th largest bank in the United States by assets. And they had about $209 billion in total assets by the end of last year, 2022. According to the FDIC. So the reason why this is a big deal is it affects the startup community in a very significant way. It is also the largest bank since the great financial crisis to collapse, which we did have some collapsing of banks back during 2007, 2008 in the great financial crisis. And so it really kind of spooked a lot of things. A lot of things happened.
Yeah.
A lot of, I think, as you would say, a Lollapalooza effect probably for SVB.
Yeah,
right?
it's a snowball. Yeah.
A snowball that really kind of collided all at once to create this quick, fast collapse. Where do you want to start with it? Let's. What are the reasons? What are all these collisions? What was happening?
Okay, so as we all know, since like November of 2021, the stock market has fallen in price, and then we've seen a lot of fallout. There's a crypto winter. A lot of things are happening. A lot of catalysts are starting to come about. These are the results of small iterative decisions in the past. The Feds have started to raise rates to attack inflation. Unemployment is at all-time lows. There's so many different facts going around, and this just so happened to combine and kaboom. So with SVP, there's a couple of core factors that happened. The Federal Reserve began to increase rates to cool down inflation. And the Fed moved quite aggressively in the raising of those rates. So as a result, higher interest rates occurred for Treasuries. SVP made a mistake in their management. It really comes down to poor management and poor communication on SVP's part, in the sense that they were so focused on having a their net interest margin, which is essentially their profit on the assets that they have. So a bank makes money by taking the assets that their deposits that they bring in from their customers and then loaning those out to other customers. And then they make money on the spread between the two. Well, as a part of their investment portfolio, they decided to buy a good portion of long-term dated treasuries at low interest rates. On average, they were pulling in 1.79% on 10-year and greater treasuries. As interest rates increased, the value of those bonds decreased because, think about it, newer 10-year bonds that are being issued at higher interest rates, any bonds older from that are issued in the past at lower interest rates are less valuable in comparison. So the market value of their portfolio decreased. Simultaneously, because they are a bank that has a niche in the startup community, what comprises a good portion of startups today happens to be companies that are involved in the crypto industry. So with what so happened was that these companies, along with other startups, were burning money since about November of 21. So what happened was those companies were pulling their deposits out, and SVB was left with these long-term assets that they had to sell in order to meet those deposit withdrawals, those customers' withdrawals. So they had to sell those securities at a loss. There's also a lot of in the weeds stuff there going on in terms of how those assets that the investment assets that the bank held, and that they were classified as available for sale or held to market. And as a result, that can play around with whether certain assets are marked to market or not. And it allows banks to invest for the long term and not have to deal with the volatility in earnings if their assets are classified in a certain fashion. But that played a part in this. We're not going to get into that, but that did play a part.
Is it okay if I jump in real quick? Okay, so Nathaniel just went through a lot. I'm just going to summarize a little bit of what you just went through. So Silicon Valley Bank made an investment in long-term treasuries, which was a 10-year time frame. 10-year plus time frame. And so what happened is that they were making a bet that the Federal Reserve would not increase rates as quickly as they had. Those rates have increased at a very rapid rate in the last year, like 12 to 14 months. And so that bet turned out to be a bad bet, which created the
relative to their customer base, what it comprised of. So if you look at, if you take SVB and compare it to, say, Chase, which is the largest bank in terms of assets in the United States, 500 billion plus. So SVB is a small minnow in a very, very large pond in comparison. Nevertheless, you look at Chase, Citigroup, the big boys, their deposits are comprised of what are called retail deposits. That's you and me, everyday average Joe, putting their checking accounts, savings accounts at their local bank, and then they deposit and withdraw. And there are many more of those accounts at these large banks than, say, for example, SVB, which their customers is very concentrated in the VC startup community. It's not only the VC startups, but it's also the VCs that are funding the startups where they have their money. So it's a very niche group. So as a result, this is not a systematic, at the way that events currently stand today, with the information that we have today, this is not a systemic issue. This is a very segregated, isolated issue for this particular bank, as well as the other two institutions that were shut down in the last week, Silvergate Capital and Signature Bank, which was shut down Sunday, March 12th. So kind of different.
Yeah, which is a really good point to point out. So again, the way that the customer in which Silicon Valley Bank worked with, Nathaniel mentioned that they were burning cash. What Nathaniel said is that they are not making profits. They need money to continue to run their operations.
So they're withdrawing it from the bank.
Correct. And so they need that money to continue their operations. And they were doing that at a higher rate than what was anticipated. And so when that burn was too great, those deposits were leaving, which means that forced Silicon Valley Bank to look at the treasuries and have to sell them to cover those deposits. But because they were in long duration treasuries, again, 10 plus years, and because rates had then increased before they made this bet before interest rates went up, but then interest rates went up, they had to sell. And as Nathaniel pointed out very well, because you can get a treasury at a higher rate than what they invested in, because they didn't hold it to maturity, they had to sell, which means they did not get all of their money back, but they got less back in principal, which was not enough then to cover the deposits that their banking clients were taking out of their accounts. So prior to this, they were looking to raise capital because they knew this was an issue. And then that's what it kind of potentially started the alarm bells for people to say Silicon Valley Bank is not solvent and they cannot protect your deposits. And then things started to escalate, Nathaniel,
it's a virtual feedback loop. Yes, it became a vicious cycle. They had to keep selling off assets, which then decreased the bank's equity and then could then threaten its solvency. And then the customers continued to want to withdraw their funds. So once a bank loses that equity cushion, that's why the regulators then stepped in. That was the perception. But I think that from what I have read, it's likely that with both SVB as well as Signature Bank, based out of New York, it's not a matter of insolvency. It's a matter of illiquidity that is the issue. Given enough time, if neither bank was forced to mark their assets to the market prices, that is, if they were not forced to say, hey, this 10-year treasury bond is actually less than what we bought it for, and we have to sell it, we have to mark it as being less than. If they were given enough time to hold their assets to maturity, then they would likely be able to meet their requirements. But they don't have the time because their clients, their customers, are withdrawing their funds. That is why those banks were shut down. Signature Bank, I'm not quite clear on yet because it's so fresh. But that, I think, is the Feds stepping in to send a clear signal to the markets that they are working overtime to make sure that this doesn't happen again, and to perhaps also be sending the message that, hey, if this does happen, we are willing to step in. But you should never take that as a guarantee, because the Fed can switch like that on a dime,
which they seem to do with raising rates so far. They've been going back and forth and making different changes. So, and also to make some clarification too, Nathaniel, I like you pointed out the difference between illiquidity and solvency. So this was an illiquid issue, meaning that their securities were just tied up and they didn't have the time to liquidate. And in order to liquidate, they were taking too much of a loss to cover the deposits that were being withdrawn from the bank. Now, from my understanding, what also then created the bigger problem is that it wasn't just the operational burn that was being taken out. Once people got wind of this potential issue, they literally just took all of their funds away from the bank and put it somewhere else because they were worried about this potential illiquidity or solvency issue.
Yes, and I'd like to off of Tim's point there, that's a very good point, because what Tim is speaking to is the FDIC insurance limit. So the FDIC insures maybe you can speak to exactly how this works in terms of like account registration, but there's some
nuance to it.
There's some nuance to it, yeah. But basically, every account in a person's name, you're insured up to, or entity's name, you're insured up to $250,000 by the FDIC. Any accounts greater than $250,000, that amount is uninsured. So what people sometimes don't understand is that by you giving your money to a bank, you are an unsecured creditor to any bank you put your money with.
What does that mean? What is an unsecured creditor?
Okay.
Break it down in layman's terms for us.
So what that means is that you're not given any collateral for essentially your loan to the bank. Correct.
Over $250,000.
Over $250,000, and then there's nuances to that.
Yeah, in simple terms.
Right.
So that's where people then went in and were like, whoa, if there's going to be some of this insolvency or liquidity, because I don't remember the percentage.
The average account balance per customer at SVB was $4.2 million. So a huge percentage of their client base, I think it was 90% or more, had greater than $250,000 in their accounts.
Which is a big risk.
It's a big risk to the bank. It's not illegal or by any sense of that. It's just a risk to the bank and to the bank's shareholders.
Yep.
And to the bank's creditors.
Which then the fire alarm went off. People started telling behind back channels, hey, take your money out. And then all of a sudden, those operational withdrawals escalated, got really fast, which then would be deemed as a run on the bank. Now, a run on the bank, I think, probably came from when people would literally probably go to the bank to take out cash from the bank.
And that actually happened. Yeah.
During the Great Depression, I'm assuming kind of.
And it actually happened this time around too.
Yep. So like that's what's called a run on the bank. And then that is what creates the issue for Silicon Valley Bank and really put the nail in that coffin, which was then that's where the FDIC had to step in and do something about this. So do we have anything else on all these things that were going on? What else we got in there?
Yes, there was a few things that I just wanted to point out in terms of like comparing this to the Great Financial Crisis.
Love to.
This isn't a repeat. This is a confluence of events in a particular sector, crypto, VC, startup related, that has
current macro environment versus where it was till then compared to
correct.
Today.
This is an isolated incident at this point in time. That doesn't mean that there couldn't be other catalysts coming that we don't know yet. This is still playing out. So this is a running news. We don't know yet. But some comparison to the Great Financial Crisis. Regional banks, it's being said, there's a lot of fear mongering out there right now saying that regional banks could be at risk. There is something to be said about that, because the big boys, the Chase, Citigroup, Bank of America, Wells Fargo, US Bank, they're very well regulated, a lot of less risk involved if you put your assets there. That being said, the regional banks and below, the smaller banks, the feds had a lighter touch to those entities, to the smaller entities after the Great Financial Crisis, because they were dealing with the big boys. So as a result, there is some possibility that maybe the regional banks and smaller there could be some risk issues, but there's no way of knowing. But what we can tell you is that if you go to your bank and withdraw all of your money, you are contributing to the problem by taking out your assets. That's not to say that you should or should not do that. That's simply a fact that you could be a part of the run on the bank, which could then potentially lead to the bank's bankruptcy, in theory. It's these runs on the bank that can make these things worse. But then there are those situations where banks do make poor investment management decisions or poor underwriting decisions, which can lead to greater risk to the bank. That's one thought. Second thought, just thinking about this, the Great Financial Crisis, 14, 16 years ago, I was pointing out to Tim before we started recording this, online liquidity. And you think, when I want to transfer money from one bank to another, it's as simple as me going online and doing one click of the button and it's done. This really wasn't in play during the Great Financial Crisis. So that you couldn't easily go online and transfer money as you can today. So this is different in the sense that money can move much more quicker. So to the point of illiquidity and insolvency, this speaks to that if I have the ability to go online and quickly move my money, as I just described, that can make things a lot faster. So it increases the risk of a bank going bankrupt because it's so much easier to withdraw funds.
Because of the speed. Correct.
So if you have a high concentration of customers in a particular industry, like this example, then the risk of that happening can increase materially if that particular niche is going through some macro issues as that niche is today. Another thing to consider, excuse me, is SVB is a publicly traded bank. So is Signature Bank. You have to wonder about incentives when it comes to the short sellers of those securities, of that stock, that equity. What are their incentives? Because there has been some short sellers saying, hey, I knew this was going to happen. I told you, because SVB released their 10K, their annual report, I think it was on February 23rd, February 24th. So 3 weeks ago, anybody who read the report could see that the fair market value of certain securities was different than the actual number that was posted on their balance sheet saying that's what they had. It's not that they were wrong or that they were doing anything illegal. They could get by doing that because that's what they were legally able to do. But the fact was that gap was equal to their entire equity cushion.
The math didn't work.
It did not work. But people could be seeing this from a mile away if they were paying attention to this and they wanted to sell it short. Some people did sell it short. And by those short sellers going on to Twitter or what have you and saying that, hey, I told you about this, their incentives are to point this out because the stock price will go down. If the stock price goes down, short sellers make money. So consider this when you're thinking about going to your bank to withdraw your money. Understand that these people have incentives. These short sellers have incentives to create this sense of fear because it helps drive the stock price down and they make money. Mm-hmm. And then, yeah, that's pretty much it. I have something to wrap up in the conclusion.
All right. We can write. Well, this is good. So now we talked a little bit about what happened. A lot of stuff happened over the weekend. The federal government stepped in.
We should talk about that. Yeah.
Yep. Janet Yellen in the chair. Janet Yellen as the
Treasury Secretary.
The Treasury Secretary stepped in, and they talked about what they're going to do and what their idea was. Could you explain to the audience a little bit about what the government has decided to do specifically with Silicon Valley Bank at this point?
So before the weekend, it was the regulator, the FDIC was planning on saying to those uninsured accounts, those accounts that had greater than $250,000 in them, they were planning on giving them a dividend or a dividend receiver, or it was essentially a security that said that upon the liquidation of the bank's assets, you will receive what is yours as a percentage of your assets versus the total that we can take off. So if my deposits comprise 1% of all of the assets within the bank, I will get 1% of whatever is remaining after everything is sold off. That's what they were telling uninsured depositors. Come over the weekend, the Treasury and the FDIC issue a statement saying that we're going to back everything, but we're not going to do it at the taxpayer's expense, which is
here it comes.
No, I'm going to be good.
We're dialing it up.
I'm going to be good, which is not true. I mean, it is technically true. So what that means is that the Fed is saying that we're going to back every deposit at not only SVB, but also Signature Bank. I'm not sure about Silvergate Capital.
Not sure about that.
Okay. But they're doing that to send a message to the markets that we will support the deposit holders.
But we will not bail them out like we did during the Great Financial Crisis.
We won't bail out the shareholders and we won't bail out the debt holders, but we will bail out the depositors. The people who have greater than 250,000 in assets, we will bail you out. And the way that we're going to do that is the feds are going to give you the money. You can get your money on Monday, today, the March 13th, 2023. And we will then raise, there's a couple of things. One, we will raise a special assessment from all member banks of the FDIC to pay any assets that we cannot sell off. And for the assets that you pledge to, so for example, SVB can go to the feds and say, hey, I bought this treasury at $100 a share, but it's trading at $70 a share or $70 per bond. And then the feds are going to say, okay, I'll give you $100. Not the 70, but the 100. They're going to pay at face value for any securities that they are given as collateral in return for basically funding these deposit withdrawals. That's bad shit. That's not capitalism, folks. That's this is the risk that you take in giving your money to a bank. You accept this when you deposit your money at a bank. I get the shareholders and the debt holders being wiped out. That's business. But when you put your money in a bank, that's not what happens when a bank closes down. You have to sell off all the assets, reimburse up to as much as you can. To give you an understanding of this, over the weekend, there were rumors that these large companies that had their assets, their money at SVB, were getting calls from private debt investment firms such as Oak Tree Capital, big player in the space, saying to them, listen, we'll give you 70 cents on the dollar for every dollar that you had at SVB that is not insured, that's above that 250 grand mark. Those were the kind of offers that companies were getting in order to get some of their funds back before the feds released the announcement on Sunday.
But if we're going to talk about that, which I understand where Nathaniel's coming from the depositor's perspective. However, let's say that it didn't happen and they didn't get their funds back. Some of these companies are not small companies, and some of these companies are small companies, right? Goes from large to big when it comes to startups. And a lot of this is then permeated within the economy. If they did not get their funds back and they were not to get it at the amount that they were, they may fail. If they fail, they also have employment. They also are producing a product for some people. So one that I heard was Rippling, which was a payroll company. And they had a lot of their funds at Silicon Valley Bank. They support a technology to do payroll. If they weren't able to do their own payroll, like pay their people, and they failed, then everybody who's potentially using Rippling either has to go to a new system, or those people also may not be able to get through to their payroll, right? Like, just as an example of the trickle down, how it could affect. So to step in for the depositors, depending on how widespread it could be, you could create a lot of contagion pretty quickly without getting some of those funds back in the hands of these companies, because they may be, I don't want to say they're, instrumental, but it could be enough where you're floating, people and small business and different things. Which is just a different take on the same issue, on where, should the Fed not step in? What should or should they not do? Or let capitalism, let it burn, kind of a thing. It's not, I think, a straightforward.
It's nuanced.
It's very nuanced, which hopefully we trusting the people at the helm that they're doing the right thing. And I think Nathaniel is correct, which he was explaining to me. He's like, it may not be a tax, but how do you get to that money? Which I know you're getting to.
No. I forgot about that part. I was explaining to Tim earlier that it's a tax on the banks, but then where do you think the banks are going to get that money from? They're going to get it from their depositors, from their clients, their customers. So what does that mean? That means they're going to charge higher rates, because that's how banks make money. They issue out loans. So they're going to increase those rates that they issued those loans at.
So you're still stripping money from the individual, just in a different manner.
It's not the public, it's the private route. Private route.
Which is also an interesting take. And again, I think that all takes have nuance to it, and depending on how you look at it. But the way the Federal Reserve, and I think it was interesting to watch who was incentivized to do what. It's very interesting to see a lot of these. I think there's a lot of capitalism promoted within the startup community, right? Very pro-business, and calling for a bailout, calling for the depositors to be right. So it's just a lot. It was a very interesting time to see what happens, but it was a big deal, and it affected a lot of companies in a lot of different ways. And they are now talking even the FDIC insurance level, because it's like, well, what do we do? These companies have millions of dollars that they need for operating capital. Do you split it across how many banks? That becomes operationally inefficient. What does that look like? Right. So I think part of the argument for the depositors is like, we didn't do anything other than, yes, as Nathaniel said, Nathaniel would argue then you should have known the risk of putting your money at a bank, and vice versa. So it's a little bit nuanced on that edge of things, which is interesting. What else got anything else? We kind of went through a lot.
I would just like to state that for those of our clients who are listening to this or watching, our clients' assets are at TD Ameritrade, which is going to be merging with Schwab. That's going to happen sometime this year. And I want to state that we are not worried about TDs, or Schwab's risk. I mean, there's always risk. There is always risk, no matter what you do.
There's no such thing as a guarantee.
Correct. Even the United States Treasury are not 100% risk-free. But we feel very comfortable with having our clients' money at TD and soon to be Schwab.
So if we were to go back really quick and just summarize everything, because we talked about a lot, which is this is a very energetic conversation. Nathaniel was very excited to watch all this. I mean, it's living history. This is going to be a historical moment.
It's very interesting
in the financial world. But Silicon Valley Bank, who was their primary customer, was venture-backed startups and also venture capitalist funds. There's a high burn rate. They made a bet on their books to do long duration or long dated treasuries.
And it was too concentrated in the long duration bet.
So the bar would be considered like a barbell strategy. That barbell was a little too heavy on the top, started to tip. The reason why it tipped is because they didn't anticipate the Fed raising rates as quickly as they did, so that their current securities were actually not marked on their books, but were valued less than what they had. Yep. Because there was increased burn from startups due to the economy not being as hot as it once was a few years ago. More capital was being withdrawn to support operations. And then people realized that, whoa, if they needed to sell their securities, they're not going to have enough, creating a liquidity issue. And then that's when people got called potentially and were like, hey, this is a big deal. People started pulling money out of that bank. All of a sudden, 1, 2, 3, bam, there it goes. FDIC has to step in, take over the bank. From that standpoint. And then from here on out, the government has stepped in and over the weekend and say, we will back all depositors, but we will essentially allow the equity and debt holders of this publicly traded company to go to away. Like, you're not going to get anything, back the depositors there. And now we see what the potential rollout effects could be new regulations for, as Nathaniel mentioned, for smaller regional banks. Maybe it could be different FDIC insurance levels could come up, maybe for businesses. And it's also put, I think, a lot of people into question from the fear mongering that's been going on is my money safe at the banks that I'm banking at personally? What does that mean for me? So it's created a lot of that kind of increase. And I think it's putting just a little bit more cherries on the top of this uncertainty of the economy at the current moment. It's just kind of like, it's just putting some more cherries on top there, maybe a couple nuts. I don't know. But that's also kind of created that idea, which we've been talking a lot, that the market in the short term is uncertain, and uncertainty creates volatility, both on the upside and the downside. Big swings are probably going to continue to happen. This just happens to be another notch on that belt for 2023. I guess we could say this every year because there's always something. There's never not nothing. There's always something going on. So I think that's a pretty good summary of kind of what happened. Yep. Nathaniel, do you have any final thoughts?
No, you said it quite well. I have nothing to add.
Okay, nothing to add there.
Nope.
The other one thing too my last final thought that we have on here, Nathaniel has a bullet point, is there had been some talk about the CEO and stuff selling stock.
Oh, right. Yeah.
We don't know a ton. I have not looked into this, right? So I've not researched it, but I have seen that I want people to understand that there's what's called a 105B-1 for executives of publicly traded companies. They fill these types of forms out to sell systematically the stock in which they are owned, because typically they're compensated by stock. And they do this so that they don't have insider trading issues. Meaning I go ahead as an executive and I set up a schedule saying I'm going to sell or buy this stock at this cadence in advance. And then it automatically happens. Because then I can't be like, hey, Thany, those marketed securities? We're screwed. I'm selling out, right? That's insider trading. That's fraudulent. You can't do that. So don't know exactly what happened with the CEO. I just know it's been a lot of discussion that there was stock that was sold, but I want to make sure that if you really want to look into it, make sure you see what the 105B-1 was, because it will give you more clarity on really what was going on. There are regulations and things put in place for this exact reason, because things happen both on the upside too. This just happens to be the downside. There's also stuff on the upside, like, oh, well, you bought into Amazon, right? When you launched this new product and how the stock price goes up, you made all this money. No, they probably did that 2 years ago. And it just happens to be that's when it happened. Timing. So just to throw that out there, that was another thing that has been kind of swirling around with this nuance. That was my last final thought.
Do your own research.
That's always a good one from him. I think that's all we got.
Yep.
Thank you, everybody, for listening to us talk about Silicon Valley Bank and what happened with these events over the weekend. We really enjoyed it, and we hope to talk to you soon. Thank you.
Bye.
Like and subscribe.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time,